Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Mark wants to know about time spreads, calendar spreads. Great question, Mark. Do they work like equity options? They're, from time to time, I want to say yes, but from time to time you could see backwardation. So I guess that's your question. When I say backwardation, that the longer dated options may have less value than the shorter dated options. I'm not really seeing that much now, but when the U.S. dollar, when the risk-free rates were at 5.25 against, let's say, the Japanese yen at around 0 or whatever it was, 0.25, the deep in the money options were actually trading at lower prices than further dated options than the shorter dated options. So once you understand the interest rate differential, and the interest rate differentials aren't that great right now, you'll see that you'll be able to understand the calendar spreads. Patricia wants to know about looking at hedging against the Australian dollar. Well, if you look at hedging, basically what you want to do is look at the contract that you're buying, which would be, let's say, depending if you're buying if you wanted to hedge dollar strength, you'd be buying puts here, and that contract is going to control about $13,800, where I think AUX closed. Well, yesterday it was 138, so I multiply 138 times 100. So each contract is going to really give me the right to control about $13,800. So I would basically decide if I need to hedge my U.S. dollar exposure, then I'd be buying puts. If I want to hedge, if I think the dollar, maybe I have too much Australian exposure and I want to, I think the dollar could go up, then I'd be buying calls. Let's see. Roberto, you can always go to www.ise.com/archives to watch this presentation again. That's really what we like to do. Also, the podcasts are available. So you can always go back at your leisure and watch it time and time and time again. William's talking about a broker that offers the options playbook, so you can go and get that. You could Google it. So William thinks it's a great way to learn more about options. So you could Google the options playbook for those of you that are interested. At this point, I want to, we have one or two more questions. Roberto, is an option from a cost point of view competitive relative to one port? That's a great question, Roberto. Question is it better for me to use stop loss orders or options? And really what it comes down to is if I think the market is going to have greater ranges in the future, buying options makes sense. If I think that the range of the spot is going to decline, well, I can find option strategies that would benefit from declines in volatility, namely selling of options, that you can earn money there also. So, that's really the way I look at options is, what do I think of the market range in the future? And then I have a sort of a methodology to trade. Question about, let's see. Question about Forex is not an asset class from and a guru. He says it's not. It's a speculative tool. Well, again, I would disagree with that. But again, everyone's going to have their own opinion. I know a lot of the largest banks in the world think it is an asset class. Some think it's not. I like to think that it's like anything. Any asset can either be used in a speculative way or in a non-speculative way. So again, that's really up to you. But from time to time, the market could move in a way that you may think is a bit irrational and may set up for an opportunity for you to trade. And that's really what I think is the best way to look at it. So whether you want to hedge, we had a question from Patricia about hedging U.S. dollar, Australian dollar. How do you hedge it? Well, basically you're controlling $13,800. You could be buying a put to hedge your U.S. dollar exposure, or a call to hedge your Australian dollar exposure if you think that the dollar is going to be moving up. And or you could be using limited risk strategies to implement a forecast, or trading option strategies. I mean, that's really up to you. At this point, if there aren't any more questions, let's see. I'm going to give everybody another 15 seconds to sort of type in questions. I want to thank everyone for joining us for the first presentation of the ISE Webinars series here in 2009. We're going to have a lot of great guests. Of course, normally I'm the host, but today I was able to present. This presentation was based on an article that I wrote, FX Option Strategies for Your Investment Portfolio. And if you'd like to read the whole article, you can go to the FX Option website, www.ise.com/FX, and you can read the whole article. And let's just hope that 2009, we all find the strategies that we'd like to trade. And again, we learn more about those strategies and learn also a bit more about actively managing the trades, because that makes a lot of sense. It helps us control our risk even more so. We don't. One of the biggest problems with a lot of these models is that one concept of value at risk, that many of these models were assumed that the value at risk was not going to be greater than a certain percentage. Of course, we've seen many assets drop or increase a lot more than we would expect. So you need to understand management of risk, and options allow you to do that. Right? Options allow you to create a lot of different strategies, but essentially you could limit your risk by buying calls or puts. Again, if you're trading the FX options product, you could buy calls if you think the dollar is going to rally, buy puts if you think it's going to sell off. You could trade spreads if you're worried about the option premiums, which means you're worried about time premium or volatility. And you can even sell options if you think the market the volatility may decline. Any of us that thought the market volatility is going to decline, let's say in early November, well, you probably did pretty well by selling options. Of course, you're probably going to want to trade with limited risk, and so I would say that credit spreads probably a way to actually achieve that. But come back to the ISE, learn more about all the different option strategies, and let's have a great 2009. On the behalf of the International Securities Exchange, this is Steve Meizinger saying, have a great trading day tomorrow, and please join us again in the upcoming weeks, where we're going to have a lot of great guests coming up. So thanks again, and have a great 2009. Thank you. Good night, everyone. On the behalf of the International Securities Exchange, this is Steve Meizinger saying, have a great trading day tomorrow.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.